And welcome back to our monthly market commentary. I about said the May edition because that's how far behind my brain is, but it is actually June. My name is Brad Gotto. I'm the founder and CEO of Fiat Wealth Management, and here with me, as always, is Mr. Tim Holland, Chief Investment Officer for TownSquare Orion. Tim, looks like you're joining us from home. Am I
I
right?
am working from home today. I can't see anything without my glasses. To your point, it's definitely June 5th. Our daughter Grace graduates from high school later
Oh,
today. And
well,
the off
congratulations.
we're very excited. Thank you very much. And our offices are pretty close to our house, but the logistics for today just made more sense to work from home so we could get to her high school on time. But
Well, that's awesome.
yeah, no, we're super excited for her and proud of her, and goes by quick. Goes
I
by
always
quick.
feel honored and blessed that you take the time to do this with us. But the fact that I get to do this with you in June on the day of your daughter's graduation, that's pretty awesome. Thanks for taking
Well,
the time.
yeah, no, I always appreciate the invite, and it's always good to be with you.
I'm also working from home.
All right.
I'm- My home does not
You
look
bought
like
you
this.
bought a hotel.
Yeah.
Congratulations.
Out traveling, industry conference today out in Detroit. We were just talking offline. I
Yeah.
love the city of Detroit. So if you're listening in and you have not been to Detroit in the last handful of years, I would recommend it. This town has been revitalized. They're doing some amazing things, but that's not what people are here for, Tim. They
No.
are here for our monthly market commentary. If this is your first month ever listening to the monthly market commentary, we try to look back at the previous month, look ahead to the month that's coming up, and then pick a data point that we think is worth discussing. And so we're going to start with that look back into the month of May. And I'm just going to name this point, Tim. That wasn't so bad.
Yeah.
There's this whole adage, and I remember talking about this last May with you. I don't know how long we've been doing these monthly market commentaries, but at least a year, because I remember the
Yeah.
last May one, because we talked about this whole adage. It's been around for a long time of sell in May and go away. Traditionally, not a great month for the markets. But we look back at last month, the S&P did 6.3%, which may not sound like a ton to some people because maybe you don't have the context. That's the best May in the S&P since HW. That would be
Yeah.
HW Bush, the
Yeah.
president that was the president from 88 to 92, and it was in 1990 was the last time the S&P did that well in the month of May. We had essentially most companies beating, the S&P as an index on the whole kind of beating earnings. We had a cooling off of the CPI. The tariff talk kind of tamped down a little bit. Talk to us a little bit about the month of May and I guess kind of a surprise a little bit, right?
Yeah. Yeah. No, the extent of the gains in 30 days, call it 20 trading days. If the S&P gives you 9-10% per annum over a long period of time, if you can do 6% plus in just a month, it's pretty darn impressive. And
Yeah.
to your point, it's been 35 years. Talk about, again, time going by quickly. And I really think, and I think in terms of all the positives, you hit on them. Earnings growth for the S&P 500 for Q1 came in at about 13%. The world thought it was going to be 7%, so almost two times the rate of expected growth. Inflation continued to move down as opposed to up. And I think, and again, sort of the tariff and trade talk improved a little bit as well. And all that met sort of pretty extreme pessimism in April. And as we talked about, the markets had already bottomed in April, but people were still pretty skittish, still off sides, as they say, kind of maybe moving away from the market, given all the volatility and uncertainty
Yeah.
of trade and tariffs, again, Liberation Day. And so the markets found their footing on April 7th and had a nice gain into month end, essentially flat for April. But then you had, again, I think still elevated pessimism, meeting much better than expected fundamentals. You blink your eyes and you're up 6% plus on the S&P and 9% or so on the NASDAQ. And given sort of the year we've experienced so far, I'll take that any day of the week.
Yeah. In fact, I think if my memory serves, and if you're an avid listener to the monthly market commentary, you can call me out on this if I'm wrong. I think last month we talked about the consumer, was it called the Consumer Confidence Index, or basically,
The American Association of Individual Investors Sentiment Survey, maybe the sort of Wall
yeah,
Street
that.
sentiment. Yeah, yeah,
Nice simple name they chose there. Um, that, but
and we
how
talked about consumer
pessimistic it
sentiment as well.
was.
Yeah, but you're right.
Yeah,
Yeah, as it concerns investor sentiment. Go ahead. Sorry.
yeah. So we had that kind of headwind going in as well.
Yeah,
The average American, I think it was 60%,
yeah,
was kind of had a negative sentiment towards the markets, and yet here we are traditionally a bad month for the markets.
Yeah.
Ended up being overall, I would say, amazing. And I don't think that
Yeah.
that's overstating it.
No.
I don't think that anybody, if we said we're going to get you, if you're, again, to be clear, we're talking S&P here, pure large equities, US equities. That is not indicative of an entire diversified portfolio. But in that segment of the market that have been beat up so bad, 6.3% in a month that traditionally isn't a great month. I think we would all take it. So
Oh
I
yeah.
think May was a win. I mean, May is the best month of the year anyway, because it's my birthday month. So, you know,
When's your
I feel
birthday?
good about it.
Did I miss that? I obviously missed it.
Well,
When's your birthday?
well, I was gonna say, obviously, it's a last day. I'm a last day of May guy. I'm a May
All right.
31st guy. So,
Happy birthday. Belated.
well, I appreciate that. It's a
Yeah.
no, it's a nobody cares birthday, right? I turned
No.
43. 43 is just
Uh,
a whatever.
no, they're all
Um,
important. They're all important.
just another trip around the sun. So,
Yeah. You look good.
um, well, thank you.
Yeah.
That's just I have a filter on. This is AI. This isn't even real me. This is AI me.
That's nothing wrong with that.
The sad part is that could be true.
Yeah.
All right. So a look ahead. Now
Yeah.
here we sit. It's June 5th. I'm going to call this point the jobs, Fed, and banks. Oh my, there's a
Yeah.
lot this month, right?
Yeah.
Because we've got a jobs report coming out actually tomorrow.
Tomorrow. Yeah.
That people are going to be looking at. The Fed meets again in the middle of this month,
Yeah.
and then we've kind of got this a bond market that it, it's got people concerned.
Yeah.
And so I want to briefly just touch jobs report and the Fed,
Yeah.
very quickly. I want to spend time on bonds because at the end of the day, the majority of the families that we work with at Fiat don't just have large US equities, they got global equities
Yeah.
and different size, mid-size, small equities, but they also have bonds in their
Yeah.
portfolio, which are meant to be more of a ballast to your
Yep.
portfolio than anything. Yet there's this concern. So I want to spend that time there, but I don't want to completely ignore the jobs report in the Fed. So can you quickly just kind of touch on what we're watching there
Yeah.
in June in those two areas, and then we'll get to bonds.
Yeah. So as we just talked about, markets have pretty much come all the way back from their April lows. The S&P is now up about 2% year to date, maybe 100 or 200 points off its all-time high. So there's been this dramatic rebound in risk assets, which is great if you're invested, and
Yep.
it's nice to see. But you were talking about sort of sentiment surveys, both Wall Street and consumer and business sentiment has been pretty weak the last couple months. And the concern has been that even if the worst of the tariffs that have been proposed by our nation and other nations haven't gone into effect, that the concerns around trade policy will ding sentiment enough that that'll ding spending and hiring, and sooner or later the real economy will start to struggle, because so far the data has been pretty good, including Q1 earnings. So we get the May jobs report tomorrow. All jobs reports are important, but people are worried that all the uncertainty of the last 8 weeks or 12 weeks, call it, has caused CEOs to just kind of pump the brakes. So
Yep.
tomorrow's report's a big deal. And so Wall Street's going to be paying attention to that. If you get a solid number, 100,000 plus net new jobs added, folks, I think will the takeaway will be, okay, we've kind of hung in there. Again, the news has gotten better around trade and tariffs. Maybe that soft data around sentiment doesn't turn into hard data that's disappointing or concerning about the economy. So there's that for sure. The Fed meets later this month. The Fed hasn't cut rates since December. Obviously, the White House would like to see the Fed cut rates. Chairman Powell at the Fed has said we're data dependent. We're worried about inflation spiking because of some of the tariffs that have been proposed and some of the tariffs that have gone into effect. So there's been this back and forth. I think as long as the jobs market looks okay, the Fed will sit on its hands in May. And interestingly enough, and not to get into politics of it all, but not that long ago, Donald Trump was talking about wanting to fire Jay Powell. The Supreme Court issued a ruling around something independent of the Fed last month, but made the point that as it concerns the Fed is a unique institution, and essentially the president really can't fire the Fed chair without only for cause. And so the Fed, even though the court case wasn't directly linked to the Fed, it's been pretty much made clear by the Fed, by the Supreme Court, the Fed is special. The Fed chair is fine. I think that creates a bit of confidence on Wall Street. So there's that. And then finally, the bond market. Bonds have sold off a bit. It sold off a bit in April. There are concerns that policy uncertainty in the U.S., again, not to get in the politics of it all, is causing some large international investors to move away from the U.S. dollar, U.S. fixed income. And as that was happening, rates were moving higher. Also concerns about our fiscal deficit, which I know we're going to talk about, in our total debt. Rates have come in of late. Bonds have caught a bid. We've got our problems like every other country, but I'm not all that worried about existential risk concerning the bond market, especially with the rallying fixed income the last couple weeks. But that was a big point of concern, that there was a bit of a buyer's strike concerning financial U.S. risk assets by international investors, large institutional investors. And I think that concern is dissipated just because of the price action you've seen in our markets, not just
Yeah.
but particularly bonds, if that makes sense.
Yeah, it's just been a lot of news, right? And then when you've got a guy like Warren Buffett, probably the most famous investor, at least in America, if not globally, making the comment of staying away from longer maturities, the headlines around interest rate volatility and how that can affect bonds, the downgrading of U.S. debt. You brought up the news of international investors in countries staying away from U.S. debt, stuff like that. It's just a lot of talk that all kind of centered around this idea of fixed income. And so one of the things that I just wanted to mention, we don't necessarily usually kind of get into advice in any way, shape, or form, or portfolio construction in these conversations. But I do think that it's worth noting that in this space, one of the things that's really, I believe, is really important, and one of the things that your team helps us out with in a significant way, is sometimes it is what you own. As an investor, owning a bond versus owning a stock versus owning a piece of real estate versus whatever. Sometimes what you own is kind of the driving force on portfolio build, but other times it's not. That's maybe not the most important. Can be just as important as how you own it.
Yep.
And so when it comes to bonds, I think more than any other asset class, how you own them is more important than any other asset class, I guess, is probably how I should say that. And so buying bonds individually and being able to hold them individually and not buying them inside of a packaged product, whether it's a mutual fund or an ETF or otherwise, becomes very important because you get to kind of control your outcomes in a more significant way. And so I understand the concern in the fixed income space, but one of the ways that you can kind of dissipate the risk or minimize some of the risks that you have is by owning bonds individually. So if that is something, for the sake of time in our market commentary here, because I don't want to get too much into actual recommendations and product specifics, if that's a concern you have and you're watching this and you don't understand the difference between individual bond ownership versus owning a fund that owns bonds and the pros and cons of each, definitely a conversation we can have with you. But this is a conversation that we're very, the concern that a lot of you have around bonds is something that we're well aware of. And one of the things that we do to stave off a volatile interest rate market is own bonds the way that we own them, which is by building bond ladders, diversifying types of bonds, maturity of bonds, and then again, controlling what we own and when we own. So just worth noting, I appreciate your sentiment on that. To your point, obviously it caught a bid here recently, which is good news, but something that we've got an eye on and we'll probably be discussing in future monthly market commentaries, I would assume. So awesome. So the data point worth discussing, I'm gonna have a little fun with this one. I'm gonna call this point, does Congress need Dave Ramsey? Now, if that doesn't mean anything to you, maybe you've never listened to Dave Ramsey, but Dave Ramsey is kind of the guru of debt reduction, right? And living a debt-free lifestyle. Obviously, the U.S. debt has been, I feel like it's in focus a lot, but it's kind of like even peaked a little higher in a lot of people's minds in the headlines. The debt has come into view because the numbers just keep getting bigger. We've got the big, beautiful bill that's sitting out there right now, and what that's going to do possibly to debt. And then what we just discussed, these headlines around some of the traditional countries and institutions buying up U.S. debt are kind of a little bit worried about the downgrade. So talk to me a little bit about this concern of our debt and kind of what it means on a global scale.
Yeah, no, and you're right. The debt's been an issue if you've been in the markets, or a question or concern for a long time, but never seemed to sort of manifest itself in a way where it really got people's attention. We always knew we were living beyond our means. We were running pretty big deficits, some years bigger, some years smaller. But in the last year or two, folks are really paying attention to the numbers. So, depending on how you do the math, we've got 36 trillion in debt, north of 100% of GDP. We're running a 6% deficit this year. And we just lost our last AAA credit rating as a country. Moody's was the final major credit rating agency to downgrade the US. And then again, I think you add that those numbers or those developments along with the idea that you've got some real meaningful policy uncertainty coming out of Washington, D.C., agree or disagree with the administration, and folks are paying attention to these numbers and the sustainability of it all. A couple points I would make is one, the U.S. prints its own currency, so the U.S. can't default, right? But if investors are worried about us living beyond our means and not connecting with Dave Ramsey and cutting spending or raising taxes, whatever it may be, on balance, investors will probably demand a higher rate of interest to compensate for any perceived increase in risk. But again, the default rate or risk for the United States is zero. So as long as you understand that and you're being compensated in terms of yield, you're going to be okay. Back to your earlier points about how you own debt, I think owning individual bonds is so important, the way you spoke to it, Brad, because if you think about buying fixed income in a package portfolio, if there are concerns about the US's fiscal position at any point in time or inflation's running away, well, those bonds will probably sell off. And if you're invested or in a commingled manner, other folks could sell out of that vehicle, force the portfolio manager to sell securities at a loss to raise capital to meet the redemptions, and you're going to lose money. If you own the individual bonds and you know that the issuer is money good, they're making their coupon payments, you're going to get your principal back at the end. You can ride out the fluctuations in price or volatility at any particular point in time. And then the final point, to bring it back to the US, which again, we have our fiscal problems for sure. We do still live in a relative world. There are countries that are more indebted than us. Most of the debt that is outstanding is held by Americans and American institutions. So we've essentially borrowed about 80% of all debt from ourselves. And even the paper, for lack of a better word, that's owned by external or international investors is mostly held by what I would consider very friendly nations or institutions, Japan, Western Europe, and so on. So again, we've got our problems. I'd like to see us get our hands around spending a bit. We'll see where the big, beautiful bill lands. But I would sort of take any concern about U.S. default or credit risk off the table, because again, we still print the world's most important piece of paper, the dollar. And because of that, it's impossible for us to default if we don't want to default. And I can't imagine we'd ever go down that path.
Interesting. A couple of points there that I just want to double down on. One, we own the majority of our own debt. I think you said 80%. And then I also found it interesting that you said of the debt that we don't own, friendly countries that own the majority of that are Japan and Western Europe. Those are countries that also have a lot of debt.
Yeah, for sure.
So, and they're out buying ours. So ironic maybe that is the case. But to your point, debt is definitely kind of part of the system, and that doesn't justify it necessarily. But from a worldwide perspective, not a lot of countries that aren't running with debt on their books as a percentage of GDP. It's going to be different. There are some countries for sure that have, we have ours is more. We run our debt at more than 100% to our GDP, which I do think obviously they need to curtail. One of the things that I've paid attention to in detail in that is that the first time we ever crossed that threshold as a country was after World War II. We were at 108 cents of debt for every dollar coming in the door. The response from the federal government at that point in time was to raise the top marginal tax bracket to 91% in 1946. And here we sit with a top marginal tax rate of 37%. And so there's a lot to be positive about and how we're trying to deal with the problem, rather than just coming to Americans and saying, look, we're going to we're going to take for high income earners 91, you get up to that last bracket, 91% of everything that you earn. In fact, I think when Reagan got into office, he used to tell the story because obviously he used to be he was an actor prior to
Yeah,
being president.
yeah,
He would only make 2 movies a year because that third movie would put him into the 91% tax bracket, and
yeah,
it just wasn't worth it. So he would shut it down. So bottom line is, I'm not justifying the fact that we have debt as a country or that we're above 100% of GDP,
yeah.
but I also don't think that the headlines that are out there are doing us any favors relative to, you know, the the fear that they're trying to
Yeah.
spike in that area.
Yeah, no, that's well said. I think again, not to look at everything through a political prism, but again, we still live in a country that's very divided, politically, culturally, socially, and I do think there's some real fear mongering around the U.S. debt, the U.S. fiscal position, bond yields, which by any account are still lower than they were 25, 30 years ago. So I do think
Yeah.
I think you summed it up really well. We've got some work to do for sure, but we should also put our fiscal position in perspective relative to our own history, including the post-World War II period, and relative to the rest of the world. I think that's super important. That's really well said.
So the most important question as we wrap up our monthly market commentary, and I didn't tell you I was going to ask you this question, I'm going to put you
Yeah,
on the spot. We were talking a little bit offline prior to this about how things age over time.
yeah.
Let's say it gets fast forward 20, 30 years. What do you think of the name, the big, beautiful bill? How is that going to age in the halls of, you know,
I had an
White
English
House
teacher.
history?
Yeah, no, I'm going to say well, just because I love alliteration. Mrs. Garrison, my sophomore year high school English teacher, just loved alliteration. I love
Uh,
alliteration. Yeah, so I'm going to go with it's going to age. I'm going to go. It's going to age well. Triple B.
All right. I love it. I love alliteration too. I never
Yeah,
even put that part of it together. So good on you for picking that up. Tim, today's a big day in your family. Thanks for taking the
yeah.
time.
Thanks.
Enjoy that graduation later today. Celebrate your daughter. And thanks for being here with us.
No, great seeing you. Safe travels home, Brad.
And actually, we get to see you face to face. You're coming out to a Wine and Wisdom event this summer. And so look forward to seeing you in Minnesota too.
Yeah, no, look forward to being with you guys.
All right. Thanks, everybody, for joining the June edition of our monthly market commentary. As always, if you want to reach out to us at Fiat, you can find us at fiatwm.com or email us at hello@fiatwm.com. Obviously, always putting this out. We have other content, educational content we're putting out every single month on that website, fiatwm.com. So, again, thanks for joining us, Tim. Enjoy the rest.